Welcome to another episode of Coffee with Clover. With the change in the global economy, as in the COVID-19 pandemic, a lot has changed and workers are trying to find different ways in which to satisfy the way they work. Some are taking out mortgages to build home offices, and others are seeking to buy a home in order to do the different changes. But when it comes onto a mortgage, how much do you know? Here to tell us all about that is Gabriel Nussbaum. Gabe, welcome to the show and thanks for coming.
My pleasure. Pleasure to be here.
So, coronavirus and pandemic, it's nationwide and it has changed the way people look at working these days. But when it comes on to taking out a mortgage, what can one do? There are people who are leaving the offices and they're heading home because they want to set up a home office. Others are looking to buy because they would like to start working from home. Where do they start?
Well, first of all, coronavirus has forced at least those that it can apply to, people to work from home. Now, if you work in a supermarket or you work in an essential service, working from home is not an option. So for those that have that flexibility and that opportunity, what you could do is you could work from home, but you don't necessarily have to work from home and be a homeowner. You can work from home and be a home renter, or you can be an apartment renter. As long as your job gives you the flexibility to do that, that's the main issue. But if you're in the market to be a homeowner, first thing I would caution everybody that right now the market is probably at the height of its valuation of property, and the numbers are absolutely insane as far as what people are paying for homes. So be very cautious. If you don't know much, tread very carefully and don't just jump in before you know what's going on. So the first thing you want to know is, what is in your budget? What can you afford? What are you making? So the first thing you have to figure out is, what will be the interest rate that you're going to pay relative to the income, to the house that you want to buy, and the mortgage that's going to consequently be a part of that house. So most times a house will have a mortgage of anywhere from 75 to 80% of the value. So you can figure right out, do you have enough for the down payment? So you got to figure out, have you saved enough for the down payment? Do you have enough money to pay now the monthly fees based on your current expenses? Now, you can go to a bank. There's two options. You can go to a bank or the bank that you're familiar with, and that bank will give you a rate depending on your credit, depending on your standing with the bank, how much products you have with them, how long you've been with the bank, will determine what they have, what they call the discount off the posted rate. And that'll determine how much of a savings you'll have on that mortgage. Another alternative, you can go to a mortgage broker, which is what I happen to be. The mortgage broker has access to multiple banks. And so now you're relying on the qualifications and the connections of the mortgage broker to now see if you can get other institutions to bid or bargain for the best rate they can give you based on the circumstances or the financial circumstances that you are in. So the first thing you would do is, as a prospective homeowner, figure out how much money are you making and how much can you afford for monthly payments. Well, you must be living somewhere now, so you figure out if the rent that you're paying is right on the periphery or close to what you can afford, the max you can afford to pay, then you know that the most that your mortgage can be is that much. Further, you have to figure out, do you have the down payment? Now, standard down payments is anywhere from 20 to 25% of the value of the house. There's also what's called CMHC, where the government tops up over and above 75 or 80%. And so you could literally buy a house with only 5% down.
For first-time buyers?
First-time buyer,
oh,
exactly.
Only.
Sorry,
Thank
you for correcting. Only if you're a first-time buyer, that would apply to you. You can take a CMHC mortgage, but you have to pay extra costs. Whenever someone gives you extra money, that means extra risk, and you're going to pay a premium for that. So if the house is worth, let's say, $500,000, and you have only, let's say, $40,000, then you'll get the extra $60,000 from CMHC, but they're going to add another maybe $7,000, $8,000 on top as a premium for giving you that extra money. So now instead of having a $460,000 mortgage, you're going to have a $468,000 to $470,000 mortgage. So those are the main things you have to prepare. Down payment, what's your monthly fees going to be, and obviously can you afford that based on your income.
Say someone's in a condo and there's not enough space to set up a home office, so then they like to get a house. So they will just sell, and the same thing would apply. How much can they afford to get a house?
Exactly. You have to figure out how much, after you sell the condo, you're going to subtract the sale price from whatever mortgage, if there is one. Now you know how much money you have, and now you can basically use that for the down payment on the house. If that is not enough, if CMHC doesn't apply because you're not a first-time buyer, you're going to have to find that extra money, or you're going to have to wait and save up. Again, my main caution right now is that house prices are through the roof, and I've just been reading that it's finally sales have slowed down. Okay, so sales are slowing down. What's not far behind when sales slow down is that all of a sudden prices will start to go down, because then there's not as much demand for the houses, and for if you have the same amount of people who want to sell them, in order to get those houses sold, price has to go down in order to increase demand.
Should one wait?
That's the $64,000 question.
That's when the bidding
I don't
comes
have I don't have a crystal ball.
Yeah.
Smarter people than me have made predictions and gotten wrong.
Yeah.
Look, when the pandemic started, okay, what's the first thing that happened with the pandemic? Nobody's working. Everybody go home. Jobs are cut. Unemployment goes up to 15-20%.
Yeah.
Government now has to throw out CERB checks to subsidize people's income. So the first thing that goes to your mind, everybody's broke, nobody's going to buy houses.
Right.
I thought my business right to the toilet.
How it rises?
It didn't rise because I'm not in the selling business, and I have more of a niche. I'm more of an investor, so it's a little different, but it didn't get hurt.
Okay,
and
good.
it did go up a little bit.
Good.
So, ironically, but the first thing I thought was, if nobody's working, how are people going to afford to buy houses?
Right.
But then there's another factor here. You see, the people who have money still were able to retain their jobs because they could work from home.
Right.
They weren't, so it's only the lower strata of income that basically suffered through this, because they either had to work they had menial jobs, so they weren't the people that were buying homes. So now what you have is you have this large group of people who have money coming in because they're still working and they're still making money, but guess what? There's nowhere to spend it. You can't go to travel. You can't go on you can't go to ball games, theater.
So it's just piling up.
Bars, restaurants. It's all. So you're making all this money. It's piling up. So now you've got all this extra supply of money, and people now want a place to put it. Right. Me, who is a mortgage investor, I found out that my mortgage rates had to go down because there's been a large supply of money coming into investing in the mortgages because people don't have anywhere to spend it. So now there's more money available for mortgage investing, so interest rates have to go down because there's a larger supply. So it's ironic how this all turned out, because at the beginning your first inclination is that prices are going to go down because nobody's working and nobody's making money. The opposite happened. We had the biggest boom in real estate in the last year and a half than ever.
Yeah, so things are getting back to normal. But then I was thinking, what if one wants to know if they're qualified? What should they look at before they come and see you? Okay. Should they come and see?
They can come and see me. They could come and see a broker, which is the same as me, any broker, or they can go to the bank. Now, the first thing you have to do is you want to say, okay, what's my credit health? Do I have a lot of debts? If you got a lot of debts and you're barely above water, which unfortunately a lot of Canadians are, then I think right now is the first thing you want to do is start paying down those debts, because the more debts you have, the less desirable you look to a potential lender, and the higher the rate you're going to pay, because you are now a higher risk of default.
You're a risk.
So first thing you want to do is make sure that your debts are manageable, and secondly, based on the rent that you're paying, can you afford much more? Because your rent is probably going to be lower than what mortgage payments are going to be. Okay, because then you've got to add taxes, insurance, repairs. All these things come into the fore that are not applicable when paying rent.
When paying rent, right.
So predicated on that, you want to make sure that you can afford over and above your rent what it is that the mortgage payment's going to be. Now is the question. How much of a house can you afford? Well, you got to figure out, okay, you're probably going to qualify for 80% of the value of the house if your credit is good. Second thing you have to make sure, do a credit check. You can go to equifax.ca and they will give you a free report right away online. And so you will know right away what your credit rating is. And there's a main number called the credit score. And that credit score is what most institutions use to determine where you are in the pecking order of your qualification for a loan and what kind of interest rate you're going to get. So the higher your credit score, the better of a loan you're going to get. So the first thing you want to do is find out your credit rating. Okay? Find out your credit rating. That'll also tell you what your debts are, because it'll show you how much
What you're
debt you
owing.
have, what you owe, and it also has numbers how often you pay. Are you late on your payments? Do you pay your debts on time? Are you 30, 60, 90 days behind? That's going to hurt you when you're looking for a loan from the bank. So you want to make sure your credit is good. You want to figure out exactly how much you can afford to make what your monthly payments are going to be. Once you figure out what your monthly payments are going to be, then based on certain interest rate, you're going to then know how much of a house that you can afford to buy. And so you kind of work backwards. You figure out how much you can afford to pay every month for your house, and you have to, again, as I mentioned, mortgage payment, taxes, insurance, and maybe some extra money in reserve for repairs. And so you're going to have those 4 main expenditures in your house that you have to think of, which are not all there. The only thing you're paying is rent. That doesn't include insurance. That doesn't include, taxes. It doesn't include repair expense. So you're going to have to add quite a bit more to your rent.
And not,
thinking in terms.
and not to forget, an emergency fund is also essential for you to have too.
Of course. Like most experts will tell you, 3 months of wages is the minimum you should have as an emergency fund.
Wow.
And most people, I would advise, live on 90% of what you make. If you live on 90% of what you make, you'll be okay.
You'll be fine.
Unfortunately, most people live on 110 or 105 to 110% of what they make, and that's why they are where they are.
Okay. So once the economy picks up, then things are looking better. What do you think interest rates will be like?
Well, now interest rates are historically low. So once the economy picks up, usually interest rates pick up with it. So I only see interest rates going up.
Up. But that's when bidding starts, and that's when you have to run.
Well, the interest rates are not necessarily directly associated with the price of the house. Most of the time they are, but sometimes they're not. I mean, here the houses are going through the roof, but interest rates are very low. They've gone down incredibly because the economy is still slow in other areas, so the government's trying to make it easier for people to invest in their business by borrow money at low rates. So they're trying to keep interest rates low for now, but I don't imagine they're going to stay low for the next 6 months. They're going to be going up.
And the name of your investment company?
Mortgage Investment Group.
Mortgage Investment Group, you should need help. With the global pandemic, I hope everyone can resurface to find what they're looking for. If you need a mortgage, Gabriel Nussbaum is the right one to go to. Thank you for joining Coffee with Clover. See you next time.